One of the challenges you're going to have in retirement is, where's income going to come from? You no longer have a salary, you need income to be coming in to replace that salary, and you want to understand where it's going to come from. Well, one way in which people do this is through owning dividend-paying stocks. And while this can be a great strategy, many people implement the strategy without fully understanding the pros, the cons, and the nuances of how to most effectively do it. In today's video, we're going to walk through those pros and cons, and we're going to give guidance to show you how can you most effectively implement a dividend-paying stock strategy to support your retirement lifestyle. Now let's back up real quick. Why do stocks even have value in the first place? Well, stocks have value because they're real companies with real earnings. And as these companies are generating earnings, the company has a decision to make. Are we going to take these earnings or these profits and pay it to people in the form of a dividend, or are we going to take these earnings and these profits and reinvest it to continue growing the company? So that's where dividends come from. It is companies making the intentional decision to say, with our earnings, we can either distribute it to shareholders, you and I as stockholders, or reinvest it back in the company. With that in mind, let's walk through how dividend investing can play out. So here's some benefits of dividend investing. Number one, it's real income that you can spend. Now this is obvious. There's no surprise about this, but when you go to the supermarket to buy your groceries in retirement, you're not bringing your account statement from TD Ameritrade or Charles Schwab saying, look how much money I have in my balance. They don't care about that. You are using cash, and dividends are cash payments from those companies that you might hold in your brokerage account. So the first benefit is it's real income that you can spend on real things, and it's tangible, and we all like that feeling of having something tangible that we can see, and it's dollars in our account balance. But the real benefit, the second benefit of dividends, is those dividends on average increase faster than inflation. Here's some numbers to show that. Since 1960, or in 1960, the dividend on the S&P 500 was $1.98. If you take the weighted average, the dividend on the S&P 500 was $1.98. Now, at the end of 2020, so keep in mind at the end of a year in which COVID caused many companies to reduce their dividends, that dividend was $56.70, up over 30 times what it was in 1960. Now, that's a compound growth rate of 5.8%. So just under 6% per year was the growth rate on those dividends that were generated by S&P 500 companies. Now compare that to the Consumer Price Index, which is just a measurement for inflation. How fast is the cost of goods and services increasing over time? Well, in 1960, the Consumer Price Index was 30. Today, it's around 267. It's up 9 times. So compare that to dividends, which are up 30 times. Inflation is up about 9 times, at least as compared or when measured by the Consumer Price Index. That is a compound growth rate of about 3.65%. So you have dividends, which is real income, real cash to pay for real goods and services, increasing by about 5.8% per year, while you have inflation increasing by 3.6% per year or so over this time period. So that's the benefit, is your income. Maybe one way in which you're replacing your salary is increasing faster than inflation, meaning you're both preserving and increasing your purchasing power over time. That's the second benefit. The third benefit is dividends typically remain resilient even when stock prices drop. So if dividends dropped every time this S&P 500 dropped, there might not be that much value to them. The value is in the sense that they are income, or it's income that we can count on. Obviously, it's not perfect. Obviously, it's not 100% of the time, but there's income that we can count on regardless of what's happening in the stock market. So let's look at some major stock market downturns and see what happened to the dividend yield in years like this. Well, between January of 1973 and October of 1974, the S&P 500 index declined 48%, so it lost almost half of its value. But on an annual basis, the dividend didn't go down at all. So my example, my very rhetorical and obvious example, when you go to the grocery store, you're not taking your account balance to pay for your groceries, for your milk, for your eggs, you're taking dividends. So while your account balance dropped by almost 50% in that year, if you were all invested in the S&P 500, the actual income or the dividends didn't drop at all from the start of the year to the end of the year. That is valuable. The income is still there regardless of what happened to the stock price in that year. Between March of 2000 and October of 2002, another really rough time in the market, the S&P 500 went down 49%. Again, almost half of its value, but the dividend yield on that, the dividends only went down by about 2%. So the stock market again loses half of its value, dividends drop by about 2%. Now, by the end of 2002, the dividend was already increasing again, and by 2003, it was already in new high territory. I mean, it was higher than it was before that downturn. So again, a resilience of dividends even through that 3-year very rough stretch from 2000 to 2002. Now, between October of 2007 and March of 2009, the great housing market crash, the subprime market crash, a lot of bad things happening during that time. The S&P 500 went down 57%. From October of 2007 to March of 2009, and that really hurt. Now, in this case, the dividend yield did actually drop a lot more than it did in previous cases, but by quite a bit less than the S&P 500. The dividend declined by about 23% during that time period. So is that fun? No. Is that painful? Yes. But is it as bad as dropping 57% like the S&P 500 did? Not even close. So what we see here is dividends showing a resilience and the ability to continue being paid and keep up again as stock markets go up and down. Because by the way, by 2020, the dividend yield on the S&P 500 had more than doubled its peak, what it was before the housing market crash in 08 and 09. So as you'll see, compared to what's happening in the S&P 500 itself, the dividend often stays relatively stable, or at least doesn't go down quite as much as the stock market does. So that's something that's valuable as a retiree, because it's the dividend, it's the income that we're receiving that we're more concerned about, not just the account balance itself. Now, those are 3 benefits of dividend investing. Let's walk through 3 of the downsides of dividend investing. So number 1, generally, dividend paying companies see less price appreciation. So I walked through that example at the very beginning. If you're a company and you have earnings and profits, you as a board and as a company decide, are we paying these profits out as dividends to our shareholders, or are we reinvesting it? Many times, the companies that decide to pay out those earnings as a dividend don't grow as much as the companies that make the decision to say, we're going to take these profits and reinvest them for future growth, which makes sense. If I'm a company and if I have a lot of great growth opportunities in front of me and I have profits coming in, well, for the sake of my shareholders, I'm asking the question, would this money be better used to be paid a dividend to my shareholders? Or can I reinvest this money into the business and grow the value of the company as a whole? So if you look at an example, Amazon. Amazon is the most successful stock in the history of stocks in terms of its annualized growth rate since it became a publicly traded stock. It's never paid a dividend. Amazon is saying as we have earnings, we are reinvesting those. And you see how that's paid off. It has led to a huge increase in the value of Amazon stock. Facebook, Google, other companies that have experienced tremendous growth, they've never paid a dividend. So not a good thing or a bad thing, but it's just showing when people focus too much on dividends, many times they are missing the growth potential in companies that don't pay dividends. Now, about 85% of all S&P 500 companies pay a dividend. So it's natural that if you own the S&P 500, you're going to own many companies that do. But if you only own the dividend-paying companies, you're going to miss out on the companies that tend to reinvest their profits and grow at a larger rate than the companies that do pay dividends. Small companies. So S&P 500 is a measurement of large and medium-sized companies. Small companies pay even less in dividends. And what we know is small companies historically outperform large companies by about 2% per year on average. So if all we're doing is focus on the dividend-paying companies, we're missing out on some great growth potential, either with large companies, medium companies, or small companies. But the goal is to say, how can we have a balance of everything? Number 2, the second downside of dividend-paying companies, or just a dividend strategy, is it's not fully diversified. Different investment strategies come in and out of favor. Dividend investing can be a great strategy, but if that's the only thing that you're doing, that can get hot and it can get cold and it can be a very cyclical thing. And if you're retired, and if you only have one type of investment, that type of investment, even if it's doing great, the value could continue to fall and go up and down, and you're exposing yourself to a lot more concentration risk than is maybe necessary. So we mentioned that in 2008 to 2009, dividends still did get cut 23% on S&P 500 companies, even as the market as a whole fell by 57%. So maybe you can't afford a 23% downturn in your income in retirement. Well, that's where diversifying into other things, whether it's bonds or cash or even just different types of stocks, can help. Whereas if everything's in dividend-paying stocks, there's not a lot of other things that you can pull money from to supplement the shortfall in a year when dividends get cut. And then 3, the third downfall of dividend investing is it's just not very tax efficient. Let's look at two companies. You have dividend company and you have growth company. And they're both, let's say, $100 per share. You can buy either of these. Well, dividend company, let's say that it has earnings of 5%. Dividend company says, great, we have these earnings, so these profits of 5%. We're going to generate a $5 dividend on the $100 per share that you have. So if I hold that, I have $100 per share, I hold that, I get my $5 dividend, but I owe taxes on that dividend. Federal taxes, state taxes. Let's say I'm in a 30% tax bracket. Well, of that $5 dividend, after taxes, I'm only left with $3.50. So my total value now of my $100 stock plus $3.50, so $103.50. Now let's look at growth company. Growth company, it also has 5% earnings, so $5 of earnings per share. But growth company says, I'm not going to pay a dividend, I'm going to reinvest that. So what it does is it grows the value of its stock from $100 per share to $105 per share. Now, me as an investor, I also own this stock. I don't actually pay any taxes on the increase in that stock value. Now, it's an unrealized gain, and as soon as I sell it, I pay taxes. But as long as I'm holding that stock, it is going up in value and I'm not paying any taxes. So on the one hand, the total value of dividend company is $103.50. The total value of growth company is $105. Now again, there's still a tax liability as soon as I sell that, but if I let that keep compounding, I'm allowing that compounding to take place before having to pay any taxes. So what we'll see here is just dividends aren't the most tax efficient type of investment. If you're owning all this in a 401k or an IRA or a Roth IRA, doesn't matter. All the taxes on that are tax deferred. But if this is in a brokerage account or outside of a retirement account, keep in mind that dividend investing is not the most tax efficient way to take advantage of some of these dividends that are going to be paid. So those are the pros and the cons of dividend investing. It can be an absolutely great strategy, but typically you don't want to do just that. To implement it most effectively, keep in mind the tax implications. Try to own maybe dividend paying stocks in IRAs or Roth IRAs or their tax-free or tax-deferred accounts. Keep in mind that dividend paying stocks don't typically go up in value as much as more growth-oriented companies. And keep in mind that your diversification as a whole shouldn't be neglected just for the sake of dividends. So if you like this video, give it a thumbs up, please subscribe for more content, and we'll see you next time.